It's a pleasure to be presenting on this panel where I'm sharing the screen to present my paper on choosing the narrative, the shadow banking crisis in light of COVID. In the Jungle Tale and the Market Tale, Ariel Rubinstein compares the iron hand of relative strength and the invisible hand of competitive equilibrium as an alternative mechanisms for the allocation of scarce resources. In this spirit, we compare two influential tales offering competing narratives for the near collapse of shadow banking in the US in 2008. First is the Congressional Tale, the report of the Financial Crisis Inquiry Commission of the US Congress. Second, the Scholar's Tale, a model of US banking of Mark Gertler and Nobuhiro Kiyotaki. So first, what I'm going to do is sketch a common two-sector framework from Hyun Shin and present the key features of the two narratives with respect to banking services, along with their diagnosis of what went wrong, and then ask what the current experience of the COVID pandemic might imply about their relative credibility. So here's an overview of beginning with Hyun Shin's model at the top, going first to the Congressional Tale of the report, plus some ideas from Akerlof and Schiller on asymmetric information. It's essentially a behavioral approach. On the other side is the Scholar's Tale of Gertler and Kiyotaki, which adds a bank run to a DSGE sort of model, a rather technical approach. It has exogenous shocks, whereas on the other side, we have endogenous shocks. And we look at the relevance of the pandemic of Contagion to each of these stories. So here's the basic structure where we have essentially two sectors that supply finance for people issuing mortgage-backed securities. They can either get the money directly from households on the right-hand side, or they can get the money via the shadow banks who borrow from the households and on-lend to the end-user borrowers. They're highly leveraged institutions. And what happens in equilibrium is the demand by each of these two sectors for the mortgage-backed securities that they hold determines the price of those securities, as shown in this diagram. On the vertical axis is the price. On the left-hand side, we see the demand curve by the banks, who follow a value at risk rule, where their own equity has to cover the downside risk. Now, risk is measured on the axis from a mean value of Q. Either the return can go up to Q plus Z or down to Q minus Z. And that risk has to be covered by equity. On the other side, we have the demand from non-banks. They don't borrow, it's all their own funds, but they're risk averse. So their demand curve slopes downwards, and the intersection at A determines the price of these mortgage-backed securities. The equations for the demand for banks and for non-banks are given on this slide. Something we're going to add later is the idea of financial panic, which was described by Bernake as follows. Before the crisis, he said, investors, mainly institutions, were happy to provide wholesale funding, even though it was not government insured, because the assets were liquid and seemed to be safe. Panics emerge, he said, when bad news leads investors to believe that the safe short-term assets they've been holding may not, in fact, be entirely safe. If the news is bad enough, investors pull back from funding the banks, and the banks are forced to sell existing loans. Well, now we turn to the first narrative, Congressional Tale, fooling, revelation, and panic. They give a key part to the three credit rating agencies as enablers of the financial meltdown. They say that the mortgage-backed securities at the heart of the crisis could not have been sold without their seal of approval. And this perspective received academic support later from George Akerlof and Robert Shiller, who looked at how markets operate with asymmetric information. One question we have to answer is, why would shadow banks actually hold such risky assets themselves? The answer is that by understating the riskiness of the assets, the banks can find a way of working around the value at risk rule, so that in practice, creditors are exposed to downside risk. But if this happens, with more expected profits on the upside, with no more losses on the downside, this raises the expected rate of return on equity for the banks. So for them, actually holding overrated risky assets is quite attractive. There is a health warning, of course, which if at length the truth comes out, this fooling equilibrium will be liable for correction. We can see this idea illustrated in the diagram with the portfolio payoffs on the horizontal axis and the payoff for equity, return on equity, on the vertical axis. And if the payoffs are not widely distributed, we could get a mean return of C. But if the payoff distribution widens, so it includes bankruptcy of the banks, which they don't have to pay for, they pass the risk on to the creditors, then the mean return goes up to C star. They increase their mean returns. This diagram may remind you of a cartoon which was used to illustrate or to criticize the Wall Street investment banks, the vampire squid cartoon. So in using the Shin diagram of demand and supply, we have here the effect of the revelation of high risk on this equilibrium is to lower the price. Both sectors demand less once the risk is revealed, so the price of risky assets falls from A to B. Banks who have to mark their assets to market will then have to contract from B to C. So that's the initial effects of the revelation of risk. But there may be a further effect, which is panic leading from C to point D. That's the arrow. For commercial banks, panic takes the form of a bank run. For shadow banks, the way it shows up is a sharp rise on the haircut imposed by creditors on bank collateral, which forces them to reduce leverage. And in the crisis, leverage was forced to fall from 50 to just 5, which is obviously catastrophic for the investment banks. We can summarize the Congressional Perspective by this picture from Caravaggio called the card sharp. What Akerlof and Schiller call this is the economics of manipulation and deception. Turn now to the second story, the second tale, the scholar's tale of efficiency, productivity shocks, and sunspots. These authors argue that normally growth of wholesale banking improves efficiency and stability in the banking industry. However, the growth of the banking system in this way makes the economy more vulnerable to crisis, as these wholesale banks with high leverage become susceptible to bank runs. The key features of their model, first of all, is there's no perceived portfolio risk. These assets are not perceived as risky. What the wholesale banks offer is not their ability to absorb risk, but they offer efficient management of capital assets. They can help people to do this. The alternative is household management, which is not so efficient and becomes less and less efficient the more capital assets are handled in this way. The equity constraint in this case is not to stop risk-taking, but to stop corporate theft. As we'll see in the two-sector model of the next figure, the cause of crisis is first an unanticipated productivity shock, followed by a random sunspot-driven bank run. So there on the right-hand side, we see, as before, the demand for risky liabilities by the banks is the red kinked line, and the demand by the households is the green line sloping downwards. In both cases, they're shifted down because of the fact that as the interests are charged in this model because of the lack of liquidity preference. We start at A in equilibrium, but then comes a shock, a productivity shock, which pushes equilibrium A to B, but this gets amplified by the leverage involved to point C. But then at point C, we have the possibility of a bank run, a sunspot-driven bank run. If it takes place, we go from C to D, and D is a point of disaster for the banking system. So that's the story from Gertler and Kiyotaki. So we can summarize it by these two exogenous shocks. The productivity shock, a small productivity shock. Here there is a small volcanic smoke cloud from Iceland of that sort, and followed by a bank run driven by a sunspot, shown on the right-hand side. So now we turn finally to the COVID connection, looking at four aspects of the current pandemic. The first of these aspects is the fact that the crisis began with a small biological shock. Now, you might think that this would support the scholar's tale, because Gertler and Kiyotaki attributed the financial crisis to a small, unanticipated productivity shock. But don't forget that well before the crisis, Rajan warned that financial developments might be making the world riskier as investors took on tail risk. So what the scholars call a productivity shock, the financial crisis committee could blame on the banks for taking on tail risk. So it's not clear which tail is favored by this aspect of the crisis. What about the aspect of externalities, which are very prominent in the COVID case, as each infected person can pass on infection to the others? Well, it's certainly true that if the drive to maximize the return on equity by the banks, by shadow banks, is very strong, this also will generate externalities. There will be unanticipated losses to creditors and disruption to borrowers if there's a panic, which of course there was. And since the crisis, there have been cries to try to internalize these externalities, ideas to increase the liability of key corporate decision makers, proposed by Charles Goodhart and Rosa Lastra, for example, and also by Luigi Zingales. The third aspect of the subprime crisis, of the contagion, of the COVID crisis, is the role of contagion. Now, in 2008, before the current COVID crisis, Robert Shiller wrote that what seems absent from the thinking of many economists is an understanding that there's a contagion of ideas is a consistent factor in human affairs, and that understanding such a social contagion is a lot like understanding a disease epidemic. And in his address to the American Economic Association, he endorsed the 3-bin susceptible infectious recovered SIR epidemic model to explain housing and credit bubbles. So here's a question: is this a fruitful way to understand how ideas spread? Well, one answer is provided by Burnside Eichenbaum, and Ravello, who published in 2016, a modified version of the SIR model to explain the boom and bust house prices. So it sounds highly relevant. There is in the paper an analysis of the SIR model, but we'll skip that here. Robert Shiller draws this parallel between medical and social epidemics, but he doesn't refer to vaccines. But in a recent Bank of England paper, epidemic models of social dynamics in asset markets are treated as cases where ill-informed noise prevails among the investors. And the cure they propose for the effects of this noise, leading to booms and busts, is one of narrative entrepreneurship, helping people to make better sense of the economy and form more reasonable expectations. This raises the question, could the central bank supply the vaccine by reducing the noise in asset markets by appropriate intervention on credit under macroprudential regulation? So, having looked at those four aspects of the current COVID crisis in relation to the global financial crisis, I want to conclude with a consideration from John Danielson, who distinguishes between two forms of explanation. One of exogenous risk coming from outside the system, affecting agents inside without being influenced by them. Think of volcanoes or sunspots. The other one is endogenous risk, created by the interaction of economic agents with their own agendas and abilities and resources. Think of the Icelandic banking crisis of 2008. Well, obviously, the scholar's tale involves the first kind of risk, exogenous risk, whereas the Congressional Tale involves endogenous risk as financial intermediaries exploit asymmetric information. But here, as in Rubinstein's fable, the choice of narrative is left to the reader. But I'd like to end on a positive note, because the regulatory reaction to the near collapse of shadow banking by making the system more resilient to risk, whatever its source, has put the banks in better shape to handle the current COVID pandemic. Your comments on this paper are most welcome. As a postscript, I should say the paper's already been published, as indicated here. Thank you.